Hello and welcome to the Mutual Fund Guide. It's all about your funds and your returns. I am Muralidhar Swaminathan. Joining me on the show today, my colleague Vandita Shivli. We have Hemant. Hemant needs no introduction. He is an expert on the mutual funds and he's been with the mutual fund industry for a very long time. Now he's a financial advisor and a mutual fund advisor. And we are introducing Ashwin Patni, who is a fund manager at Axis Mutual Fund. Gentlemen, welcome to the show. Ashwin, I'll come to you first. I think this is one of the most volatile situations and uncertain situations in the market. What is your assessment of the current market? Do you think that the correction that we are seeing, is that going to be temporary or will it be a little prolonged?
So we've had, to answer that, I'll also take a little step back. And, you know, if you look at the last 2-3 years, I think we've had a very interesting dichotomy between what is happening in the underlying economy and the markets. So I think 2016-17, we've seen the stock markets do really well. When the underlying economy went through a bit of up and down because we were having some disruptions, we were also having some reforms that are getting implemented. Interestingly, this year, we are actually seeing a role reversal of sorts where we have seen the underlying economy pick up pace and actually earnings growth looking like they will look at getting sustainably in a better shape. Seen the underlying economy pick up pace and actually earnings growth looking like they will look at getting sustainably in a better shape, whereas the markets have taken a little bit of a correction. So I think to answer your question, yes, there have been hiccups in the recent past. We've seen some corrections. Of course, when market want to correct, they find reasons to correct. But from our perspective, from a medium to long-term perspective, we are not at all worried because the underlying fundamentals are getting better. And ultimately, I think when the macro is more supportive or the fundamentals are more supportive, then ultimately the markets do find support from that.
Right. So given the uncertainty, my question is, before I go back to the issue of NBFCs, your recent fund launch, Axis Growth, you're also going to select stocks from outside India. Selecting stocks in India itself is challenging. How do you select from outside?
So it was we believe that there was a bit of a gap in the market currently. If you look at the Indian mutual fund industry, and I think if you look at over the last 8 to 10 years, we have done a fantastic job in getting people to start looking at allocating into Indian equities as a long-term option. And I think we can really accept now that over the last 3-4 years, it started becoming more of a cultural thing where people start doing SIPs or people allocate to mutual funds. And I think that is becoming part of sort of habit, which you can say. So I think we felt that this was a right stage for us to introduce investors to the fact that 97% of the global market cap is actually outside of India. So India, of course, is a great market, successful market, but we are only 3% of the world global market cap. So the next logical step for investors, therefore, is to start seeing what could be the interesting opportunities outside of India. And that's where when we were looking at this new fund idea, we said that can we take a small step by making a 30% odd allocation to stocks which are outside of India.
Right.
Interesting.
But which are the markets outside India?
Basically, I think
it's not US because they are in the midst of the longest bull run.
So see, the idea again is without really trying to sort of time or look at the near-term ones, but from a strategic perspective, US is, if you look at the market cap comparison, again, US is 40% of the global market cap.
Right.
So any large strategy, you do have to allocate. And also, I think the interesting thing when we studied the sort of model portfolios and the opportunities available there, the interesting thing that comes out is there are certain themes which are big themes over there which we just do not have access to in India. And I think the biggest one which needs no introduction is the technology and consumer internet space.
Right.
If you
which
look
is
at
simply not available here.
So today for even in India where e-commerce and internet and technology plays a very big part for consumers here.
Correct.
But if you want to play that in the listed space, there is no way to do so.
Absolutely, you're right.
So that this is a great example of why an international portfolio can really complement the best ideas of. So that's where I think this fund that we launched, the Growth Opportunities Fund, the idea was to do a 70-30 mix,
right.
70% domestic, 30 offshore.
Right.
We were also looking to tie up as an advisory. So as Axis Mutual Fund, we are a JV joint venture between Axis Bank and Schroders. And what we are doing is Schroders has a very large global capability in terms of investing across the global equity markets. And what we are also doing, therefore, is working with their global equity fund managers to create a model portfolio where we can work with them and they can help us sort of identify the best 25, 30 global stocks in which we can deploy the money for the 30%.
Before I hand it over to Vandita to take the next question to Ashwin, let me come to you, Hemant. You made a very important point, Ashwin, about how this has become a cultural issue now. Everybody wants to invest in mutual funds. Everybody says that I'll go through SIP. Till yesterday, it was all about balanced funds. Now there is a very interesting product that they are offering. 30% of the portfolio will be invested in international stocks. How do you react to this kind of a Franklin Templeton, by the way, in their IT portfolio, I think they have some 10 to 20%, which is why they've done better when we were not doing better. What's your thought on that?
I think there are two important aspects, Murli. Clearly, one is you need to see from the diversification point of view. It's always a great idea if you can diversify internationally. Second important thing is I think one of the reasons why it has also been kept at 30% is because it doesn't change the tax status, because the moment you reduce it from 65% in domestic equity, the taxation will be a debt, this thing. So I think that's an important aspect. So while you are, diversifying internationally, you're also retaining the tax benefit which are available for an equity fund. But my view is clearly that, as I mentioned, from the diversification point of view, it's a great product. Only those investors who build a portfolio, those who have built a portfolio of, domestic equity, should be looking at these funds to begin with, because you need to understand that different markets behave differently. Of course, there is a scope, there is a diversification. You can do better, and we have seen that some of the markets have been doing better, especially US has been doing better than us. So I think it's a great option for investors to diversify internationally. But I would say initially to be looked at only by those investors who already have built a portfolio, reasonably big size, experienced domestic equity, not someone who's starting to invest
relatively new to the fund industry. I think the next question you want to ask him about it's a slightly tougher one.
Okay, so we have seen the NBFC bubble, it has burst and made life difficult for all the fund managers. How are you coping with that?
So I think we have to, again, if I were to look at the larger context, you have to look at that in the last 2 or 3 years. What happened really was that bank lending was constrained because a big part of the banking system was not really able to grow their balance sheet. And I think there was a space in which we saw the opportunity getting filled up through, more enterprising NBFCs who stepped in and sort of were able to take advantage of the opportunities which existed. And therefore, I think there's a really large role that the NBFCs have played in terms of, fulfilling customer needs and taking advantage of market opportunities to exist. We believe that this sector is really here to stay. It is a very important, plays a very important part in terms of, servicing very specific customer needs, especially I think in the retail finance. They have done some really wonderful work, specific NBFCs. So on the whole, clearly I think that is a space that is very, very much a required space. It's here to stay. It has some fantastic players. What we are seeing, of course, in the market is a little bit more of a knee-jerk reaction related to a specific couple of events which happened. And I think, our own view is that things eventually should stabilize, and people will, once they stabilize, that immediate knee-jerk sort of reaction gets, goes through. Then the markets will go back towards the fundamentals. You're not saying that all NBFCs are good, not all NBFCs are bad. People should look at each one on their own merits and on their own fundamentals, and which is what will happen, I think, once things stabilize.
So are you cutting your exposure to any of the NBFCs right now in this kind of a situation? Because till yesterday NBFCs played a different game. So liquidity was abundant, money was cheap, and they went about lending to everybody, and they also got good ratings from rating agencies. Now, in a market like this, would you still say that, look, if I have exposure of, let's say, X%, 20% to finance overall, of which NBFC is so much, whether it's the Diwan housing or the LIC housing, the market was crazy about them. Today, there is a complete change. So how will you churn in such a situation? Will you say that I will reduce my exposure to NBFC, or will you say that I'll stick to the best of the NBFCs? Because getting out is also difficult now, I suppose.
Yeah, and that's where I think it goes back to having a very robust investment philosophy and strategy in the first place. Sure. Because you cannot, in the middle of a situation.
Right.
You have to have a plan and you have to have a stock selection which takes care of the long-term scenarios. So therefore, if you look at Axis Mutual Fund, what we always have done is we've tried to focus on quality stocks, quality stocks that have a more sustainable, what we call the more sustainable growth prospect. So what we mean by that is essentially make sure that the companies have a good quality balance sheet, their managements are capable, they have a good business plan in terms of being able to generate sustainable profitability. If we are able to identify such stocks and we invest in them for the long term, then typically what we have seen is that when times like these happen, corrections happen, then while definitely in extreme corrections all stocks will take some kind of a hit, but what we have seen is that quality stocks invariably they find some support at some stage, because there are people who understand the underlying strengths of the business, and the buying support comes at some stage.
Right. Before I come back to this question, the next question, which I'll once again hand it over to Vandita, I want to tell our viewers that, in a market like this, we'll be taking calls and queries very soon. I'm sure they're all waiting by patiently. I will line up them soon. In a market like the current one, buying is something that scares you. Selling you can't sell because you will lose. So, Hemant, what would you advise SIP investors? Stay invested or increase the investments?
Look, we need to understand why do we invest through SIP. There are two major reasons for that. One is that you want to accumulate a corpus over a longer period through smaller contribution, very clearly. Second is you don't want to commit all the amount at particular market levels. You want to benefit rather than worrying about market volatility. And if you really see in the last 6 months, it's only those guys who have been investing systematically have actually benefited from the lower levels. I mean, the rest of the guys who are looking at investing lump sum have stayed away, right? So clearly, I think investing in a disciplined manner through SIP makes a lot of sense. The only thing is, to make it easier for you to be able to handle this volatility, it's important that you have a time horizon in mind. You should know clearly. So that's why we always recommend that you should invest for a longer period. And what it does for you is, for example, if you're investing for the next 10 years, I mean, that will stop you from doing something, right, in a haphazard manner. Because you know that you have 10 years on hand, why should you worry about the market level today? So the fact that you're investing systematically, exactly, the fact that you're investing systematically, you're investing at a lower level, and that brings your average cost down. And if you really see the SIP till Jan, okay, every installment that was going at a higher level.
Absolutely.
It's only in the last 6 months that you've seen that you're getting more units for the same amount.
Very important.
And that will bring your average cost down. So I think a long-term investor should be actually, it's difficult to be happy in these circumstances, but actually shouldn't be really worried about what's happening in the market, because you are bringing your average cost down, and you will be among the first investor who will benefit the moment the market turns around from here.
Right. So basically the message is very clear. In a market like this, you might think that it's going to scare you away, but not really the case. If you are a long-term investor, you are buying your mutual fund at a cheaper price, and if they are large cap and blue chip funds that you are investing, you are buying those stocks at a much cheaper price than what it was 6 months ago. Vandita, the next question is from you.
Okay. So the question is that in a market like this, the current one, where hybrid funds face greater risk, they are hit from both sides, equity and debt. What's your take on that?
Well, the most important aspect when you start investing is deciding your asset allocation. The reason why it is important is because you decide what kind of risk you are taking in your portfolio. Okay, because if you have, let's say, 50% equity and 50% debt, you know the kind of risk you are taking, and also ascertains for you what kind of return can you expect. So I think once you do asset allocation, you have different ways of doing that asset allocation. Either you can go for equity and debt fund, or you can go into hybrid fund. Now there are a variety of hybrid funds which are available. You have debt-oriented hybrid funds. Then you also have hybrid funds which are investing in a mix of equity, arbitrage, and debt. So if you have chosen your hybrid fund well, and again, hybrid funds are ideal for basically medium-term horizon. So if you have another 5-7 years to go before you require this money, okay, your equity portion may be getting hit today, for sure. But again, the same principle. If you are following a disciplined manner, if you are investing systematically, if you are having a very clear view on your time horizon, okay, these times will benefit you, because your investment now, even in the hybrid funds, is going at a lower level. So I think it's very, very important for every investor to first look at asset allocation and then look at fund, because each one of us may have a different way of looking at things. If you're a smart investor, you may look at equity and debt separately. If you think you can't decide, go into hybrid fund. Don't worry about the volatility. Keep focus on the your time horizon, and make sure that your fund is among the consistently performing ones.
Let the fund manager worry about the volatility. How would you manage this kind of a situation? Because both equity and debt are taking a knock. How are you managing a hybrid fund in this situation?
So clearly it goes back to that same philosophical point to make sure that I think one thing that we have always tried to do at Axis Mutual Fund is that make sure that we run the stubs, both the equity and debt portion, like standalone funds. Give them the required effort, time in terms of making sure that we're creating a good quality portfolio. And if you do that, then you make sure. Then what you do is that there are times like these, you are able to withstand the ups and downs in a little bit better way.
To what extent have you managed to withstand the pressure?
I think, clearly, in the short term, the markets, when you are market-oriented product, the ups and downs will be there reflected in the NAV. The important thing is twofold. One is, to what extent are you correcting not in a sort of day-to-day basis, but let's say if you take a 3-6 month period when your markets do face correction, then what has happened. And the second important thing is, how sustainable is your return profile when you take a 1 year, 3 year view.
Sure.
And we go back to that sustainability because that's a very important thing from our perspective, because the return, for the investor to enjoy the return has to be sustainable.
Right.
It is not enough that as a fund manager we show 6 months fantastic returns.
No, I fully agree.
But then, in the next correction, if those returns get taken out, then investor really is not able to.
How much of the shock have you absorbed?
So, I think obviously we have different funds and different funds have reacted differently. But I think important point is that our portfolios are robust, and what we have seen is that across our range of hybrid funds, we have been able to withstand the market impact quite well.
You've managed to withstand the pressure coming from both the markets, equity and debt. I think on that note, I need to slip into a very short break, and on the other side, we'll answer queries from mutual fund investors. Stay tuned. Welcome back. You're watching the Mutual Fund Guide. Let's go straight to the first query. Vikas Agarwal from Bahrain has mailed us this query. He's 34 years. He has an SIP of 1,000 each in Reliance Pharma, Kotak Standard Multi-Cap, Canara Robeco Emerging Equities, Principal Emerging Blue Chip, HDFC Hybrid Equity, Bank of India, AXA Ultra Short Duration, L&T Emerging Business Fund. That's a lot. Okay. He aims to create a retirement corpus of 3 crore. What's your view? He wants to know how much more should he invest for the 3 crore corpus. I think he's investing about 7,000 to 8,000 a month. And 3 crore, I think he's 34 if we assume another 20-25 years.
Yeah, I mean, if I take retirement age to be at 26, let's say I take 26 years, assuming an annualized return of 12%, he needs to invest around 14,000 to get to his target. 14,000. Important thing is going to be, you're going to be seeing times the way we are seeing right now. He needs to stay put. He needs to continue his investment process. He should not get really bugged about what's happening in the market. 7,007 funds, clearly a case of over-diversification, according to me. As I mentioned earlier, I think asset allocation is very, very important. I see one debt fund there.
Yeah.
I don't really see a role of debt fund for when you have a time horizon of 26 years. There's a hybrid fund and there's a sector fund. The sector fund investing obviously has its own pros and cons, but it's not for someone who has a small portfolio, trying to build a portfolio, should stay away from sector fund. And even hybrid fund for 26 years, I think well-diversified equity fund is a large cap or large cap or multi-cap can do a better job here. So I think these 3 funds, according to me, should be out of the portfolio. The remaining 4 are good combination of large and mid-cap. He can continue, but as I mentioned, 14,000 is what he needs to invest. He's investing 7,000. He needs to increase his SIP by 7,000, and he should do it as soon as possible. Otherwise, he's going to see a gap in what he wants to build up and what he can build over his defined time horizon.
Right. Very clearly, because too many funds, you don't need debt funds. Try and restrict to multi-cap and large cap and double your investments from 7,000 to 14,000. On that note, let me go to the next query. This is from Bengaluru. Chennakuvaran has sent us this query. He is a senior citizen and wishes to invest in mutual funds to get regular income. He wants to invest 50 lakh in lump sum and accumulate rupees 6 lakhs per annum without eroding his principal amount. What's your recommendation? I think he is looking at a slightly higher return compared to FD.
Well, good thing about mutual fund is that they offer product for every investor, for every time horizon, every risk profile. even for him, I think there are a number of products. As we discussed earlier, there is a debt-oriented hybrid fund, which used to be earlier known as monthly income plans. Then there are other hybrid funds which have a mix of equity arbitrage to a varying degree. Okay, so 2-3 things you need to look at. One is that 50 lakh that he wants to invest. He needs to ascertain what is that percentage of that in overall portfolio for retirement. So it shouldn't be more than 40-50% because you are investing in market-linked product, which obviously you have to face vagaries of the market from time to time. So you need to be a little careful there. Second is, like I said, there are a number of products which are available from the mutual fund industry, but then your expectation have to be very realistic. 12% post-tax, because the dividend distribution of 10% means you're looking at 13.5%. Year on year, not possible. I think you need to come in with a realistic expectation. So my thing would be that yes, hybrid funds, especially equity-oriented hybrid funds over a longer period can give you 12%, but to expect post-tax year on year is not possible.
And also not from the very first year.
Exactly. Exactly. So 2 things he needs to do. I think he needs to look at a mix of equity saving, balance advantage, and equity-oriented hybrid funds in a manner that his equity exposure should not be more than 40-50%. All these funds enjoy the tax status of equity funds. So, take a combination of these 3. I can recommend a couple of funds. And in equity saving, I would recommend maybe Kotak equity saving. In balance advantage, you can look at ICICI balance advantage. And in equity-oriented hybrid, you can look at Reliance equity hybrid fund. So this is, I think, very, very important from the allocation point of view. Second thing is, there is a better way of generating regular income in a more tax-efficient manner. If he allows his money to grow for a year, then he can opt for systematic withdrawal plan. So what typically happens is that every single rupee that you get today as dividend, you have to pay 10% tax on that. If you go for SWP, you can tell the fund how much money you need every month. So there what happens will the capital gain, long-term capital gain instance will come down. So I think he should be able to reduce his tax, which he's going to pay as a DDT to a large extent. So I think opt for SWP, opt for a combination of these 3 funds. And as I mentioned again, the role of market-linked product from mutual fund should not be more than 50-60% in the entire portfolio.
In fact, the rate of taxation is so high; it's much higher than the rate of return that you get even from a fixed deposit.
Yeah.
Right.
Yeah, and they can also benefit from the potential of compounding over time.
Yes, absolutely. I mean, that's the advantage. That of course, whether you go for a traditional option or here, as long as you allow your money to grow, you will get it. But the fact remains that traditional options, considering the fact that tax angle, if you look at a bank FD, for example, and if you're on 30% bracket, you're paying 30% tax, right? So even if you're getting 7%, you're hardly left with 5%. So there's no way you can beat inflation. So you need to necessarily look at market-linked product, but it's very important to have them in the right proportion. So that because ultimately you're a retired person, and you can maybe, handle volatility, but only to a certain extent. So you need to be very careful in terms of composition of your portfolio.
Yes. All right, we move on to our next caller. Achal is online from Delhi. Hello, Achal, what's your query?
Okay, I think we have lost the connection. We'll reconnect with Achal in a while. Can we take the next query? Okay, before we reconnect, I'll come back to Ashwin. What's your advice for people who come and say, look, I want to build a corpus of 2 crore over a period of 20 years, 25 years. The goals are fine, because in 20-25 years, if you're earning a certain amount now, there are so many things that you will take into account, 5-year, 10-year, 15-year, 20-year. What will be your advice to them in terms of fund selection? What kind of category?
I think Hemant made some very important points in terms of making sure that the asset allocation has to be thought through. You cannot just go by the name of the fund or looking at the 3-year, 5-year history or whatever the performance number is. You have to just make sure that you understand where the fund is investing. So the first step really is to say that, okay, fine, if I have to create a corpus, what is an appropriate asset allocation for me? So much should be in equities, so much should be in fixed income, and then use that knowledge to create the appropriate funds. And I think the very important part, which really comes down to it when you're talking of very long periods of time, is discipline.
Right.
Because when you talk about a 20-year time frame, and you can talk about the previous 20 years, from 1998 to 2018, we have seen at least 3 different corrections which have seen markets correct by 30-40%.
In fact, I think the next caller is exactly
So we just have Achal online from New Delhi. Hello, Achal, what's your query?
Hi, so my query is that I am 24 years old right now and I'm looking to invest 20,000 through SIP mode, And after 2 years, I required a good corpus for my higher education. So I just wanted to know that how should I allocate my assets of 20,000 per month. So which kind of fund shall I go? It's multi-cap, mid-cap, small-cap. I'm just looking forward for the advice.
I think, any decision that you make, as I mentioned, asset allocation is very important. Here, the time horizon is just 2 to 3 years. And that too, if the money has to be invested on a monthly basis, your average holding period is just about 1.5 years. So I think it's very, very important that you should not be taking too much risk at this level because the money is required for a specific purpose. At best, if you're looking at investing in mutual fund, you should be looking at maybe a combination of low duration debt funds, I would say, and maybe some amount in equity saving, which basically restrict the equity exposure to 10 to 15%. I think these are two categories of fund you should be looking at. I mean, if you can't take any amount of risk, then you're better off maybe investing in some liquid fund where you know that you can still get better than what you would get in saving bank account. And if you keep it for 3 years, then you get indexation benefits. So in terms of tax efficiency, you will still get a better post-tax return than what you would get in the bank. So clearly, the focus has to be on the purpose for which the money is required, and the time horizon plays a very important role there.
Right. Thanks, Anchal. All the best for your future education plan and your investments. Play it safe. Don't take risk because it's very short term. A similar advice for people who have lump sum and who want cash flows post-retirement. Don't take too much risk. Plan it properly. And for youngsters who want to hold on for 20-25 years, there are a number of options which our experts have given. Thanks so much, Hemant. Thanks, Ashwin. I think that's all we have time.
Yes.
We have to wrap up the show and hand it over to the next show. It's a wrap on this edition of the Mutual Fund Guide. Stay tuned to Btvi for more news and updates on the other side of the break.